Everyone is terrified of a housing crash like 2008, but if you own a home today, a crash isn't actually your biggest problem. Your problem is that by 2026, you likely won't be able to sell your house at all. We're entering a phase economists call a liquidity trap. It's not just about losing value, it's about losing your exit strategy. And the data shows that 50% of homeowners are already locked in. This isn't speculation. This is documented in a 52-page Federal Housing Finance Agency working paper that almost nobody has read. Researchers found that for every percentage point that market mortgage rates exceed your original rate, the probability you'll sell drops by roughly 18%. The lock-in effect prevented nearly 1.7 million home sales between mid-2022 and mid-2024 alone. That's not a soft market, that's a frozen one. Here's the number that explains everything. Just over 3%. That's the average mortgage rate for homeowners who bought or refinanced between 2020 and 2022. Right now, rates hover around 7%. Do the math on a $400 mortgage. At 3%, your monthly payment runs around $1,700. At 7%, nearly $2,700. A homeowner wishing to move faces over a 70% increase in monthly payments, $1,000 more, every month, for 30 years. A recent Bankrate survey found that over half of U.S. homeowners say they wouldn't feel comfortable selling at any mortgage rate this year, up 12 percentage points from last year. The ultra-low rates of 2020 to 2021 have become golden handcuffs, starving local housing markets of supply. And the transaction data proves it. Sales of previously occupied U.S. homes totaled just over 4 million last year, the lowest level since 1995. The housing market slump has now dragged into its fourth consecutive year. We're witnessing something unprecedented, a market where half the participants have essentially removed themselves from the game. Not because they don't want to move, because they financially can't afford to. If fewer people are selling, shouldn't prices stay high? That's the conventional wisdom, but conventional wisdom misses what happens next. Markets need liquidity to function. They need buyers and sellers actually transacting. When half the market refuses to participate, you don't get stability, you get fragility. Think of it like musical chairs where half the players superglued themselves to their seats. The game keeps going, technically, but it's not really a game anymore. It's people frozen in place, waiting for something to break. And something always breaks. Here's who's actually vulnerable. First, life-change sellers, divorce, job relocation, medical emergencies, death in the family, growing families that can't fit anymore. Life doesn't care about your mortgage rate. 3 to 4% of homeowners fall into this category every year, regardless of conditions. That's millions of households forced to transact when the math is brutal. These aren't reckless speculators or over-leveraged flippers. These are ordinary people whose circumstances changed in ways they couldn't predict or control. Second, the entire bottom of the housing ladder is broken. The share of first-time homebuyers has dropped to a record low of just 21%, while the typical age of first-time buyers climbed to an all-time high of 40 years. That share has contracted by half since 2007. Historically, first-time buyers accounted for 40% of sales, with a median age around 30. When young people can't buy starter homes, existing homeowners can't sell to move up. Move-up homeowners can't sell to downsize, and the entire chain freezes solid. Meanwhile, look who's actually buying. Investors bought 1/3 of all single-family homes sold in Q2 2025, the highest percentage in 5 years. But here's the critical detail everyone misses. Institutional investors are selling more homes than they buy, and have been for 7 consecutive quarters. The big players, the ones with sophisticated data and rooms full of analysts, they're heading for the exits. When the smart money leaves, you should be asking why. They see something coming that most homeowners refuse to acknowledge. Here's how liquidity traps become liquidity crises. When enough forced sellers enter the market simultaneously, they don't set prices. They take whatever buyers offer. And buyers, sensing desperation, offer less. This creates a reference point. Suddenly, comps in your neighborhood show a sale at 15% below what you thought your house was worth. The next forced seller sees that comp too. They price lower because they're even more desperate. This is how cascades start. Not with a dramatic crash, but with a slow, grinding descent that feeds on itself. Each distressed sale creates conditions for the next distressed sale. And those people locked in at 3%, every price decline eats into their equity cushion, the one thing that made staying put feel safe. When your home's value drops enough, you're not locked in by golden handcuffs anymore. You're just locked in, underwater, unable to sell without bringing cash to closing, unable to refinance because there's no equity left. That's the trap within the trap. We've seen this before, though the mechanism was different. In the mid-1980s, oil prices collapsed and took Texas with them. Home prices fell 11%, while the nation rose 32%. Harris County saw 30,000 foreclosures in a single year. Over 225,000 workers lost jobs, and 130 banks failed. But here's what matters for today. Houston's home price index peaked in 1983. It didn't recover until 1997. 14 years to break even. 14 years of watching neighbors walk away. 14 years of being trapped in a home you couldn't sell. Many people couldn't sell because selling meant catastrophic losses. So they stayed for years, watching equity evaporate, unable to move for new jobs, unable to escape declining neighborhoods. Today's lock-in is different in mechanism. Rate spread rather than negative equity, but the outcome rhymes eerily. A generation frozen in place. A market that looks stable on the surface but is actually paralyzed underneath. And paralysis is just fragility wearing a mask. When the system finally has to move, it moves all at once, violently. Here's the realistic scenario based on current data. By early 2026, more mortgage holders will likely carry rates above 6% than below 3%. This is a critical threshold that changes everything. The payment advantage of staying locked in is weakening quarter by quarter. People who thought they'd stay in their pandemic homes forever are realizing they can't. Life circumstances change whether you want them to or not. The average American moves every 7 to 10 years historically. Meanwhile, adjustable rate mortgages and HELOCs from 2021 are resetting to current rates. If your HELOC adjusts from 3 to 8%, your payment doubles overnight. No warning, no negotiation, just a new bill in your mailbox. What you get is a slow-motion crunch. Not a dramatic crash that makes headlines, something arguably worse, a market that simply stops functioning. Buyers who can't qualify for mortgages at current rates. Sellers who can't find buyers at any price that makes financial sense. Transactions grinding to a halt while carrying costs keep accumulating. According to the National Association of Home Builders, roughly 3/4 of U.S. households can't afford a median-priced new home at current rates. To afford the typical home today, Americans need an annual household income of nearly $117,000, up about 50% since 2020. That's not a market correction waiting to happen. That's a market that's already broken. The numbers simply don't work for the vast majority of potential buyers. Here's what I need you to understand. When half of mortgage holders have rates so far below market that selling destroys them financially, you don't have a functioning market. You have a standoff. And standoffs only end two ways. Either something external changes dramatically, rates drop back to 3%, incomes surge unexpectedly, or internal pressure becomes unbearable and forced selling overwhelms everything else. The Fed isn't coming to save you. Dropping rates to 3% requires another major economic crisis. And if that crisis happens, you've got much bigger problems than your mortgage rate.